This is Homebuying 101 with Ryan.Flodin and Matthew Blier. It is a beginner's guide to buying your first home. We'll start off by going over the goals for this course, and the goals are to learn the advantages of owning a home, explore the different loan programs that we offer, discuss the cost of being a homeowner, understand how credit scores can affect your options, which have a huge impact, complete the pre-approval process, and then I will answer any questions that you have. First of all, let's talk about why buy instead of rent. So the whole conversation about renting versus buying, like what are the advantages of buying? Well, let's face it, owning a home can be a wise investment. Homes tend to increase in value and you can build home ownership and interest over time, meaning you can actually build equity. And interest on your mortgage is typically tax deductible. Of course, consult with your tax advisor regarding tax deductibility. So why else should you consider buying instead of renting? There's other advantages. Well, number one, you own the home. You can personalize it. You can make improvements, right? You can obviously buy a home if you have needs of a growing family. And of course, a starter home is a great way to be able to build equity. This helps you build personal wealth. And lastly, you stop paying someone else's mortgage because when you're paying rent, you're paying someone else's mortgage. So those are some of the advantages of buying versus renting.
Hey everybody, how's it going? Matthew Blier here with Bean Group. Excited to help you on your home buying process. So it's as easy as 1, 2, 3. First, you want to find your home team of experts. You want to find an experienced real estate agent like myself, a knowledge mortgage professional like Ryan.Flodin with Movement Mortgage, and a trusted insurance agent. Second, you want to complete the mortgage pre-approval process. You want to submit a loan application, collect all the necessary documents, and explore loan options. And then the third thing you want to do is, again, consult with your real estate agent, see what's available, see what's out there. Where do I want to live? Location, location, location. That's everything. And then when can I start looking? And that is the 3 steps you want to focus on.
So let's break this down a little bit, right? Here's some Home Buying 101, getting down to basics of home ownership. So let's talk about the factors of the pre-approval. You've heard about pre-approval. Well, what goes into being pre-approved, right? Well, let's talk about how you get pre-approved for a loan. The number one, what determines your ability to get approved for a mortgage? Your credit history, your employment status, right? Are you employed, your income, existing debts that you have, and any down payment that you might be making. So let's talk about the importance of credit history. What determines your credit score? Let's take a look. If you look at the top bar in green, about 20% of your credit score is determined by any new credit you've applied for or types of credit. Next is the length of credit history, meaning how long have you had lines of credit open. And then the 2 biggest factors of what determines your credit score, how much you owe and what's your payment history. Literally, you can see 35% of your credit score is determined by how on time do you make your payments. So are you maxed out on credit cards or other loans, and do you pay your bills on time? That's the biggest determining factor that's going to influence your credit score. So some important notes about credit history. Your FICO score, as it's called, is an indicator of how you manage debt. So if you have, as I said, a history of making payments on time, it's a good indication that you'll make your mortgage payment as expected as well. Now, keep in mind, why is having a good credit score important? Well, because it can impact your interest rate. It can impact how much a lender requires for a down payment and ultimately how much you can borrow. The good news is you don't need to have an 800 FICO or 20% down to purchase a home. Who here thinks that's good news, right? It's awesome. Now, obviously, when you're applying for credit, make sure you obtain a copy of your credit report from your lender. So let's answer the question then. How much do I need for a down payment? Answer, it depends. Today's flexible mortgage programs can make down payments for first-time homebuyers less of a challenge. Today, there are loan programs with flexible down payments, including low or no down payment options. Some homebuyers may be eligible for down payment assistance, and of course, the amount you put down will impact your mortgage payment. Of course, let's be prepared for mortgage closing costs that may include title, home inspection, appraisal, attorney, and recording fees. And make sure to be upfront and clear with your loan officer of exactly how much you would like to put down. And then review your estimated out-of-pocket costs and fees as related to buying a home. How much can you afford? The ultimate question, right? Well, let's take a look at what goes into determining how much you can afford. Number one, lenders are going to use your credit history, right? And determine what's called a debt to income ratio. A debt to income ratio is used to determine the loan amount that you qualify for, okay? So what does debt to income ratio mean? It is typically the anticipated total housing payments plus your existing debt payments divided by your gross income. Does that make sense? And certain loan programs offer different qualifying guidelines for expanded debt to income ratios, lower down payments, and loan amounts. We're going to talk about all of those. The key is to get pre-approved so you know exactly how much house you can afford. Does that make sense? You with me? All right, cool. So let's talk about what does your mortgage payment typically include. What's included in a mortgage payment, right? Your mortgage payment consists of four amounts known as PITI. What does that stand for? It stands for principal, okay? Interest, that's the interest rate, and taxes, right? Those are the property taxes you pay, and homeowners insurance. So PITI, principal, your loan balance, otherwise known as your principal, your interest rate, your property taxes, and your homeowners insurance. Those are the four elements that go into making up your principal, interest, taxes, and insurance, your PITI. Your mortgage payment, there it is, ladies and gentlemen, your mortgage payment. Now, a couple of notes about that. Your taxes and your homeowners insurance may be held in an escrow account to be paid out by your mortgage company as needed, and depending on the loan program, there may also be PMI, which is private mortgage insurance. That will also be added to the loan amount. That typically comes into play when you put less than 20% down, but we also have other ways of getting around that, and I can go over all of those programs with you. So what type of loan is best for you? Well, when talking about loans, the first step to take is to learn the two basic classifications of home loans. There's conventional and unconventional. Let's explain the difference because each loan type has its advantages and disadvantages for the borrower, for you, right? Let's take a moment and explain the main differences. Conventional loans, here's a simple way to understand what a conventional loan is. It's not insured by the government. Conventional loans are your standard non-government mortgage. They are not guaranteed by or insured by a government agency such as the FHA, Federal Housing Administration, the VA, Department of Veterans Affairs, or USDA, the Department of Agriculture. Conventional loans are also known as conforming loans, and conventional loans are backed by Fannie Mae and Freddie Mac, the two largest investors of conventional loans. They have very specific loan underwriting criteria. Fannie and Freddie have invested in nearly half of all U.S. home loans, and they're very important to homeowners and potential buyers alike. Conventional loans typically have lower debt-to-income ratios and higher credit score requirements. Lower credit scores impact interest rates, and if you're putting less than 20% down, you'll need mortgage insurance, which tends to carry a higher cost as compared to unconventional loans with less than 20% down. Now, that's not always the case for some people, and there are some ways to be able to get around mortgage insurance, and if you'd like to talk with me about that afterwards, please don't hesitate to reach out. So what are some types of conventional loans? Well, number one, conforming. Conforming is a term used to describe loan limits set by Fannie and Freddie. For most of the U.S., the conforming loan limits are a maximum of $726,200. Some areas of the country are considered high-cost areas like Rockingham and Stratford counties. And in those high-cost areas, the conforming loan ceiling in most high-cost areas is $828,000. Non-conforming loans are loans that are not backed by Fannie or Freddie Mac, and they exceed the conforming loan limits. Jumbo loans are a type of non-conforming loan because they exceed the conforming loan limits even within the high-cost areas. Fixed rate loans, of course, are the most common choice. The interest rate stays the same for as long as you have the mortgage. Many buyers choose a 30-year fixed rate loan because it usually results in an affordable monthly payment, but shorter term are also available. Adjustable rate loans have rates that may go up or down over time. Adjustable rates usually adjust annually after an initial fixed rate period of typically 5, 7, or 10 years. So the main benefit to a conventional loan, if you can meet the underwriting guidelines, is lower total costs compared to unconventional loans. So let's talk about unconventional loans. What are they? They are loans that are backed by the U.S. government or local state agencies insured by the government. When we talk about unconventional loans, we're typically referring to FHA, VA, and USDA. Unconventional loans can include FHA, USDA, state, and local bond programs. Bond programs are used by city and local governments to help fund down payments and lower the cost of buying a home for community members who otherwise might not be able to afford it. These types of loans offer more flexible qualification guidelines. VA loans, of course, are backed by the Department of Veteran Affairs. They generally do not require a down payment, but veterans and active duty personnel who secure a VA loan do need to certify that they intend to personally occupy the property as their primary residence. So which type of loan is right for you? Well, the loan programs we discussed today offer a range of finance and down payment options. Interest rate is only one component to obtaining the ideal mortgage for your situation. And by working with an experienced mortgage professional like myself, you can select the loan that best suits your budget and goals. I will go over your payments with you. I will go over your closing costs, how much down you'd like to put, and that way you could figure out exactly what you're walking into before you even go and look at a home. So let's talk about the home buying process. Now that you have an understanding of the loan programs available and qualifying, let's take a look at the home buying process. 6 steps to buying a home. Step 1, complete the loan application. Provide income and asset documentation, get a pre-approval letter, and share that letter with your agent. Let them know you're ready to go shopping for a home. Step 2, review your pre-approval with your realtor and discuss your purchase options and formulate a plan to see the homes that fit your budget and needs. Step 3 is to start your home shopping. Stay focused and don't get discouraged. Always stay in contact with your realtor and lender and do not engage in any large spending or obtain credit during this time. You found your new home. Now what? Congratulations. Step 4, this is where you work with your realtor to make an offer on the home you've selected to purchase. You review the offer with your lender and update your pre-approval as needed. Submit your offer with your earnest money deposit. Step 5, order an appraisal and property inspection. You'll work with your lender to do this. Collect updated documents and information. Acquire homeowners insurance. And your loan is thus reviewed for final underwriting. Step 6, receive final loan approval. Review final closing statement and coordinate with the lender and attend the closing. Sign documents and get the keys to your new home. Remember to consult with your lender before making any big purchases or job changes during this time. So let's take a look at a recap. What did we cover here today? What did we learn, right? Congratulations, first of all, you're an educated consumer. Let's review the points and get with your mortgage professional for more details. That's me. Here's what we discussed: the benefits of owning versus renting, the importance of getting pre-approved, understanding your credit report and your FICO score, and your down payment options. We also covered closing costs, loan programs, mortgage payment details, understanding PITI, and we reviewed the 6 steps to a home buying process. Continue to reference those as your guide along your journey.
Hey guys, how's it going? Matthew Blier here again. So the class is over, but where do you begin? Got questions? We're here to help. Let's talk. Links to myself, Matthew Blier with Bean Group, and Ryan.Flodin with Movement Mortgage are in the links below. Feel free to reach out to us anytime. We're excited to help you. Thank you. Thanks for watching.